You'll love Mindful Moments.
Oh, yeah.
It's like a deep dive for your mind, offering a refreshing perspective on everything from science and philosophy to history and art,
Wow.
all in under 20 minutes.
That's great.
Yeah?
So if you're ready to nurse your mind on the go, check out Mindful Moments via the link in the show notes. Trust me, you won't regret it.
We usually think about oligarchies as something that happens in other countries, a system where people just buy power.
Yeah, through blatant acts, like you just buy somebody off.
Right.
But what if a similar kind of concentration of influence happened here?
Right.
But not through corruption, like the traditional way we think about it.
Right.
But through access, like kind of these subtle pathways of access and a shared financial ideology.
That's what we're looking at today, right? How a powerful financial elite gained influence in the U.S.
Yeah, and it's fascinating because it didn't just happen overnight.
Right.
Right. This is something that, it's interesting to look at the evolution of our financial system from its very beginning.
Okay.
You see surprising connections to the issues that we're grappling with today.
That's what we're going to do today, is we're going to try to understand how a small number of large banks came to hold so much influence over American finance. And we're going to look at the key decisions, the philosophies that led to this power, and then we'll try to figure out what are the potential consequences.
Exactly.
All right, so let's start at the beginning. Where did this all begin? Where did the seeds of financial power in the U.S. come from?
I think you have to go all the way back to the founding of the country.
Okay, back to Hamilton.
Yeah, Alexander Hamilton's proposal for the federal government to assume state debts after the Revolution.
That was a big deal.
It was huge because what it did was it established the United States as a credible borrower.
Okay.
Which then created a more stable foundation for banking to develop. And so what's interesting about this is this idea that, right from the get-go, establishing that the nation is creditworthy, that creates a foundation for financial power, for better or for worse.
And banking did develop, really rapidly, right? I mean, we went from just a handful of banks to over 100 in just a few decades. What fueled that?
Yeah, so a really significant factor in that growth was the introduction of limited liability for shareholders of banks.
Explain that for us.
Yeah. So basically, before limited liability, if you were a bank owner and the bank went bankrupt, you were personally liable for all the debts. You could lose your house, everything, right?
Oh, wow, okay.
But limited liability basically says, okay, you as an investor, you're only liable for the amount of money that you've invested.
Okay.
That's it. So it really lowered the risk for investors, made it much more appealing for people to invest in banks.
Okay.
And you see it in the numbers. By the 1820s, the U.S. had more bank capital relative to its population than Great Britain.
Oh.
Which is really striking.
That's interesting, given that Great Britain was much further ahead industrially.
Right.
Yeah. But we also know that, especially early on, there was some skepticism about these banks.
Oh, yeah, big time.
Right. Jefferson, Jackson, they were really wary of these institutions.
Yeah.
They didn't necessarily think that they were all good.
Yeah, and both of them viewed a strong central bank as, this potential source of corruption, that it could, undermine democratic principles.
Interesting.
Yeah. And, you think about Jackson dismantling the second bank of the United States, that, really underscores how deep-seated this distrust of concentrated financial power was.
They were really worried about these private financial institutions gaining too much influence.
They were afraid of it, yeah.
Yeah. But it is interesting to note that even without a strong central bank in the early 19th century, the U.S. economy kept growing.
It did, yeah.
We kept innovating.
Yeah.
That makes you think about the necessity of some of our modern financial structures.
Yeah, it does.
Okay. Let's move to the late 19th century, right? We've got the rise of these industrial titans.
The Rockefellers.
Yeah.
The Carnegie.
The Vanderbilts.
Yeah. How did finance fit into that era?
Well, by the late 19th century, industrialization had created this immense wealth.
Right.
And we have this new, powerful economic elite.
During this period, the U.S. was a leader in innovation and wealth creation.
Yeah.
And finance, I would say, was primarily playing this supporting role, connecting savers with productive investments.
Right. But even though they were playing a supporting role, this powerful industrial class, including finance, they weren't necessarily afraid to use their influence.
Well, no, they weren't shy about it.
To get some advantages from the government.
Yeah. So, the American political system, it's always allowed sectors that are, really profitable to lobby for favorable treatment.
Tariffs.
Tariffs, tax breaks, all sorts of things.
Yeah.
And the thinking at the time was well, look, what benefits our industry will benefit the whole nation.
Okay. But, then you've got Teddy Roosevelt, who really comes in and challenges these concentrations of power.
Busting up the trusts.
And his concerns weren't just economic, were they?
No, not at all.
No.
Roosevelt was really interesting because he was concerned about the concentration of power for both economic and democratic reasons.
Yeah.
He truly believed that these dominant private interests, they threatened both fair markets and the health of democracy.
Yeah.
And his actions, like when he went after trusts like Northern Securities, really show that he was committed to a more open, a more competitive economic system.
Yeah. And that's an interesting thing, right? That these early tensions and efforts to manage financial power,
Yeah.
they were right there at the very beginning. Let's fast forward a little bit to the early 20th century, right? We're leading up to the Great Depression. The Federal Reserve is established.
Right.
What role did it play in the events leading up to 1929, the crash?
Well, there's a big argument to be made that the Federal Reserve could have actually softened the blow of the 1929 crash had it taken more decisive action.
Okay.
So basically, the Fed was very hesitant to raise interest rates during the 20s to kind of like curb all the speculation that was happening.
Yeah.
And, that arguably contributed to the severity of the crash when it did happen.
Right. And then we've got the crash, followed by the Great Depression. There's debate about whether the Fed could have done more to lessen the impact of the Depression, too, right?
Yeah, and a prominent view is that, like, the money supply just shrunk so rapidly due to, like, all the bank failures in the early 30s, and that this contraction of the money supply was really a key factor in the depth of the Depression. And the argument goes that if the Fed had been more assertive, expanded credit, stabilized the banking system, they could have limited some of the economic damage.
Right. So then we get the regulatory reforms of the 1930s under Roosevelt.
Right.
And the Glass-Steagall Act is obviously a big one here. What was so significant about that?
Yeah. So the regulatory framework of the 1930s, especially Glass-Steagall, it was all about, like, trying to reduce risk in the financial system and protect individuals.
Yeah.
So Glass-Steagall separated commercial banking, which is like, handling deposits, from investment banking, which is, trading in securities. The idea was to prevent the riskier activities of investment banks from destabilizing commercial banks.
Yeah.
And after these reforms and the creation of the FDIC, the banking system was way safer for a really long time, like decades.
Yeah, it's like they learned a lesson, right?
Yeah.
Like we're going to try to course correct.
Right.
But then in the 70s, things start to shift back towards deregulation.
Right.
What were the main things that drove that change?
Well, you have a bunch of factors happening at the same time.
Okay.
High inflation in the 70s and this increasing influence of academic finance theories.
Okay.
Stuff like the efficient market hypothesis,
Right.
which basically says that financial markets, they're inherently efficient and they don't really need a lot of regulation. And then, you have this broader trend politically toward deregulation as well.
This academic influence seems really important here.
It is.
How did these theories, like the efficient market hypothesis, you've got models like Black-Scholes, how did these things end up leading to deregulation?
Yeah, well, they provided this intellectual justification.
Okay.
The efficient market hypothesis suggested that asset prices already reflect all the available information, meaning that government intervention is not only unnecessary, it could actually be harmful.
Okay.
And then the Black-Scholes model, that gave people a framework for pricing complex financial instruments, like derivatives. And that really spurred the growth of derivatives.
But I think it's important to note that not everyone in academia agreed with these ideas.
Oh, absolutely not. Even as these theories were becoming popular, a lot of economists were voicing concerns about, how well they actually worked in the real world. And they were pointing to things like irrational behavior, information imbalances, these factors that could really throw a wrench in the whole system.
And then, we've got the Reagan administration.
Yeah.
They're strongly in favor of deregulation.
Big time.
How did that play out in terms of policy changes for the financial sector?
Well, the Reagan administration, they really pursued deregulation actively, especially with people like Treasury Secretary Donald Reagan, who came from Wall Street.
Oh, okay.
And you get legislation like the Garn-St. Germain Act, and that broadened the powers of banks, allowed them to do all kinds of new things, and facilitated interstate mergers. This really spurred innovation in areas like mortgage lending, which, had its downsides too.
Right, because then you've got the savings and loan crisis in the 80s, and that seems pretty directly linked to some of these deregulatory moves.
Yeah. The S&L crisis really showed the risk of like really rapid deregulation without enough oversight.
Yeah.
They basically allowed these SNLs to get into riskier areas of lending, but they didn't really have the expertise. And there wasn't enough regulatory scrutiny, and that led to widespread failures, huge cost to taxpayers.
Yeah. So we're moving into the 90s and the 2000s. What does the financial landscape look like? Because there's this talk of like a new financial oligarchy emerging from this period of deregulation. How did that happen?
Well, you see the financial sector just growing dramatically, both in size and in profits. I mean, it just becomes a much bigger part of the U.S. economy. And alongside this deregulation, the average compensation in banking just skyrockets.
Wow.
I mean, compared to the rest of the private sector, it's crazy. And all this new economic power, it translated into political power for Wall Street.
Okay.
But it wasn't necessarily through, like, illegal means,
Yeah,
right?
no.
It was through things like campaign contributions.
Right.
Lobbying, the movement of people between Wall Street and the government.
Yeah. So not necessarily traditional corruption,
Right.
but more like, shaping the environment through this influence and access.
Exactly. It was a lot more subtle. It was built on these shared ideologies and close financial and personal connections between Wall Street and Washington.
Yeah. And this kind of brings us to the 2008 crisis. Financial innovation plays a huge role here,
It does.
particularly derivatives like CDOs, credit default swaps. Can you explain these in a way that I can understand? And, how did they contribute to the crisis?
Yeah, I mean, financial innovation can be a good thing, right?
Hmm.
In theory, it should improve risk management, capital allocation.
Right.
But we had this really rapid growth of complex derivatives like CDOs, collateralized debt obligations, and CDSs, credit default swaps. And these became central to the entire financial system. And so think of it this way. You take a bunch of mortgages, hundreds, even thousands of mortgages, and you bundle them together into this new investment product. That's a CDO. And so some of these mortgages are good.
Right.
Some are bad.
Right.
And then, different slices of this bundle, different tranches are sold off as having varying levels of risk and return. So, it seemed like you could diversify away the risk of the bad mortgages.
Right.
But the accounting for these derivatives, it was often really opaque, meaning banks didn't have to hold as much capital as the risks they were taking on might have warranted. And the credit default swaps, those were basically like insurance on those bundles.
Okay.
So if those bundles go bad, the insurance is supposed to pay out.
Okay.
But what if the insurance company itself doesn't have the money to pay? That's a problem.
Right. And then the mortgage market itself is going through this massive transformation.
Oh, yeah.
Right. You got the rise of subprime lending.
Huge.
Yeah.
So the mortgage market just explodes.
Yeah.
You have this surge in subprime lending. So these are loans being given to people who don't meet the traditional standards for creditworthiness.
Yeah.
And you get these new mortgage products with like really low initial payments, really relaxed standards for giving out the loans. And the focus really shifted from like holding on to these loans long term to just originating them and selling them off. So it became this fee-driven business that was all about volume.
Okay.
And you also have this push to increase homeownership, which also contributed to the expansion of subprime lending, even to people who couldn't really afford it in the long run.
Right. And so then you've got banks that are creating these off-balance sheet entities, like these things called SIVs, to kind of mask the risk that they're taking on.
That's right. The SIVs, the structured investment vehicles, they let banks hold assets, especially like the riskier parts of the CDOs, but they didn't have to hold as much capital against them.
Right.
So essentially, they were increasing their leverage and their potential risk.
Okay. So we've got all this innovation, we've got all this risk-taking. What's happening with regulation at this point?
Well, there was a lot of resistance to regulating these new financial instruments,
Okay.
like especially derivatives.
Yeah.
In the 90s, Wall Street lobbied really hard against regulating them.
Okay.
And a lot of people argued that these markets were working just fine without any meddling and that any intervention would just stifle innovation.
And then, of course, you have the credit rating agencies. They're giving these really high ratings to these really complex securities, right?
Yeah. And the credit rating agencies, they were really important because they facilitated this massive growth of the market for structured securities like CDOs.
Right.
But they were also under a lot of pressure from the banks. The banks paid them for the ratings. And so there's evidence that banks would like shop around for the best ratings, and the agencies would be reluctant to push back because they didn't want to lose business.
Right. Right.
And so you get a lot of these really risky securities backed by subprime mortgages getting AAA ratings.
Wow.
When in reality, They were very risky.
And even attempts to regulate, like predatory lending, that faced opposition too.
Oh, yeah. As people started getting more and more concerned about the quality of these subprime mortgages, the attempts to regulate them were often blocked.
And all this is happening while the Fed is keeping interest rates really low, which some people say fueled the housing bubble.
Right. So the Fed's low interest rate policy in the early 2000s made borrowing for housing really attractive.
Yeah.
And that contributed to housing prices just shooting up.
Right.
And so the argument is that all this capital was going into housing instead of more productive business investments.
Right.
And that led to unsustainable growth.
And then the bubble bursts. We have the 2008 crisis.
Yeah.
What is the government's response? I mean, you've got this panic that's unfolding.
Yeah, it's a full-blown financial meltdown.
Yeah.
So Lehman Brothers collapses.
Yeah.
And that triggers like widespread panic, credit markets freeze up.
Mm.
And so the government has to step in with these massive bailout programs to try and prevent other big financial institutions from collapsing.
Right. And the terms of those bailouts were really criticized. Right.
Yeah, a lot of people said that the government should have demanded more in return for all that financial assistance.
Right.
That they were way too favorable to the banks.
And it seems like the largest banks, they actually benefited from the crisis in some ways.
Yeah, I mean, that's a key point.
Yeah.
So the crisis leads to a bunch of financial institutions failing or merging.
Right.
So that reduces competition.
Right.
And then you have this implicit guarantee from the government that, like, okay, if you're a big systemically important bank,
Yeah.
you're going to get bailed out.
Yeah.
And that gives them a huge advantage in the markets.
Right. And, if our listeners are interested in learning more about, like, financial crises and bailouts and stuff like that, I always recommend checking out Mindful Moments.
Yeah.
It's an AI audiobook analysis channel on YouTube. They do a great job of breaking down complex topics. It's kind of similar to what we're doing here, trying to unpack these financial events in a way that's easy to understand. So yeah, if you're interested in that kind of stuff, definitely check out Mindful Moments and, our podcasts.
Exactly.
So we bailed them out, right? But did we actually fix the underlying problems? What about the aftermath of the crisis? What about the Dodd-Frank Act?
Well, yeah, the Dodd-Frank Act, that was the government's big response to the crisis. Okay.
The goal was to increase oversight of the financial system, enhance consumer protection, and create a way to resolve failing financial institutions without having to bail them out.
Okay.
But Wall Street, they lobbied really hard against a lot of the regulations in Dodd-Frank.
Yeah.
So it wasn't as strong as it could have been.
Right. And there's still debate about whether these banks are truly no longer too big to fail.
Okay, absolutely.
Yeah.
The too big to fail issue is still a huge concern. People have proposed different solutions, like putting limits on the size of financial institutions, maybe separating traditional banking from riskier activities, that kind of thing.
And so, I mean, it sounds like even with all these reforms, those fundamental issues, the concentrated financial power, the potential for systemic risk,
yeah,
those may still be there.
That's the scary part.
Yeah.
Like, despite all the reforms, the same conditions that led to the last crisis.
We've got this concentrated financial sector, a strong government backstop, and a lot of incentives for risk-taking. Those things may still be present.
Yeah, that's something to really think about. So listeners, here's a question for you. Even with all the regulatory changes, are we really more secure? Are the forces that led to the last crisis still at play? We really want you to think critically about the structure of our financial system and how much influence this small number of institutions have.
Right.
And while you're thinking about that, we really encourage you to subscribe to the show. We do deep dives like this all the time. Share this episode with anyone who you think might find it interesting. If you really want to go deep on this topic, pick up the book.
It's a good read.
Yeah. But most importantly, just keep thinking critically about these issues.
That's the key.
Because they affect all of us.